East and APAC investment strategist at BlackRock Investment, joining in on the show right now. Ben, hi, great to have you on the show. Ben, amidst this global reset, what's the strategy? Because the more and more we speak to people, it seems like diversification, not just globally in terms of region-wise diversification, but also within asset classes. That seems to be the mantra.
Good morning. Yeah, I think that is exactly right. So we at BlackRock, the world's largest investor, are really hyper-focused on the need for investors to adopt a slightly more active approach to managing their portfolios. So what do I mean by that? I mean, during the Great Moderation, this period of time that ran roughly from the global financial crisis to COVID, with hindsight, we can say, really, it was an everything bull market, and the right approach to managing risk was just be long, don't touch, and that worked very, very well. Moving to today, sadly, we're in a much more complicated situation, very clearly. Geopolitically, we have a fracturing world, trade tensions and all of that. And we have a revolutionary technology in artificial intelligence creating significant headwinds and tailwinds for different parts of the globe, cutting it by geography, by asset class. And then to your excellent point, even within asset class, I think we're going to have to be very picky, thinking about specific sectors, maybe even individual securities, which are the right side of these mega forces, which are creating a very different macro context and therefore requiring, we think, investors to have a new investment playbook.
Right. Ben, hi, this is Harsh here. First off, setting out of India, I'm curious to know what the tactical view on India is, because we've seen such a strong outperformance by some of the other Asian peers. India has lagged. Does this mean that tactically you're liking India more, maybe the next 6 to 12 months?
Yeah, I think firstly, I would say India has done nothing wrong, really. I mean, so we've just been the wrong side of a couple of exogenous shocks, if you like. So firstly, we've had the AI mega boom, and that's fine, but that sort of lent itself more to other markets, Korea, Taiwan, even China tech within the emerging market complex. And then secondly, clearly, we've had the overhang from the US trade tensions. And it seems to me that both of those have evolved very, very significantly. Just overnight, we've had at the swearing-in ceremony of the new India ambassador, the US ambassador to India, President Trump made fairly sketchy but interesting remarks about how we seem to be close to a deal. India will love him again, and so forth. So it's always hard to exactly discount precisely what that means, but encouraging signs, I guess, in terms of this, clearly what's been a significant overhang from being in the focus of the US administration. It really looks like we could have a deal relatively soon, and that would be great news. That's the first point. The second point, given we've been a little bit on the sidelines in India, valuations have reset very, very dramatically. So India was trading at a fairly substantial premium to other emerging market equities. That's now normalized very, very, very substantially. So from here, looking forward, I'm actually pretty constructive for all the reasons we're all aware of, vis-a-vis deregulation, bank deregulation, interesting comments from SEBI yesterday about how they are looking to do more to make the capital markets even more attractive for global investors. CPI very low, allowing RBI to do more. I won't go through the full laundry list, but there's a lot of things to like looking forward. And it does seem to me that those two big kind of overhangs, the AI boom playing out elsewhere and the US tensions, seem to be much better discounted now than they would have been, let's say, 6 months ago.
Interesting. But Ben, for the FPI or the hot money, it's always been a tactical trade between India and China, right? What is it that you're sensing? While the Chinese equity markets may be doing one thing, what about the economic data points and that entire DeepSeek rally? Do you think that has sort of played out?
I just to gently push back about the premise of the question, we could be both, right? So I think for global investors, there are kind of deep questions like, what is a neutral weighting for India looking forward? So we at BlackRock, structurally, we have a kind of a strategic overweight in India because we just feel it's fundamentally underrepresented when you think about the scale of the economy, the scale of capital market evolution. I mean, just a quick stat, India's market cap is now roughly equivalent to the UK and Germany combined. So, it's a very, very huge market and economy. So just to, gently push back, it feels to me that India will evolve to being more than just a hot money trade from the perspective of global investors. Now, to actually come to your question, China continues to be a very, very interesting microcosm of the global kind of situation whereby the economy is, I would say, dull. It's not terrible. It's not great. It's plodding along at relatively slow growth rates by Chinese standards, certainly much slower than we're going to see in India in the year or two ahead, I would have thought. But to your point, they are in the game when it comes to the AI megaforce. So very interesting questions about who's going to win, the US and China, the US or China. Jensen Huang making a very inflammatory, he's the boss of NVIDIA, the big chip company, making a very interesting inflammatory comment that he thinks it could be China, given their engineering heft. And AI ultimately is a physical thing. You can stub your toe on AI. I know it seems like magic, but you need the data centers, you need the power generation. When AI becomes physical through robots and all of that, China's got a very obvious, huge engineering kind of scale, which likely can be on the right side of that. So China, I would say, is another example of where we need to be picky. The overall economy, kind of dull, ongoing headwinds from property, from demographics, and of course from the US-China relationship, let's call it. But they are kind of geared into the AI megaforce, and that means selectively there are bright spots in the Chinese equity market, I guess, as we've seen play out over the last few months.
Ben, trying to contextualize why you as well as BlackRock are overweight US, the kind of rally we've seen, are you overweight from a perspective that there's going to be liquidity coming in given rate cuts, or are you overweight because only the AI trade has actually played out and the rest of the market, ex-AI, looks fairly okay? Give us a sense of that.
Look, I just think we have to accept that it's a raging bull market in artificial intelligence. That just seems to be true. And therefore, not just the US, again, you can look at Korea, you can look at Taiwan, you can even look at other asset classes. You can think about copper, given the power we're going to need to have the silicon brain do its thinking. It needs energy. So there's different ways you can take the thought, but clearly US equities is on the list and might even be the top of the list. I think that's fair to say. So we are appropriately nervous about the rally. There is a whiff of euphoria, which is always a little bit unsettling. And clearly the concentration where you've got so few companies dominating the index, we are aware of that, I think it's fair to say. So we are nervous about all of those things. But for now, the fundamentals, right? It isn't just euphoria. It's a boom being driven by money. The demand for AI and the money that is being spent in creating more and more AI infrastructure and architecture moving forward continues to positively surprise. So there is excitement. It does feel like a hinge moment in human history. But the good news for us in our US equity overweight is there's also just good old-fashioned earnings. And more than that, there's earnings positive surprises that continue to come through, driving these AI stocks further up and to the right. We think that's going to continue, and that's largely why we continue to be overweight US equities.
Ben, what is the right way? And when I say right way, in terms of the sectoral flavor, if you will, just across the world, not getting into company specifics here, because you've always talked about AI being the mega force, like you rightly described, the entire rally in the US equity markets, or for that matter, part of it in China as well, is driven by AI. What's the right way to actually look at AI? Should it be via consumers? Should it be via hardware, the engineerings, the data center, power, etc.? What's the pocket in the supply chain that one can bet on and not go wrong?
So there's always risk. I should hedge a bit here, right? There's always risk. So not go wrong is a high barrier, high hurdle to clear entirely. But where we would be taking risk, I think, what are we doing as investors? We are capitalists. And we are providing capital to solve problems. That's what the deal is, right? So we do a deal, we invest, and we earn a fair return in order to solve problems that society has. That's why apps are created, companies are created to speak to a demand that isn't being serviced by pre-existing companies. So when I look at AI, I try, of course, I'm interested in the kind of magical elements. What does it mean for my children? What kind of labor force are they going to be? All of that is very, very interesting. But at work, with my tie on, what I really try to focus on is the problems, the constraints. And can we as providers of capital help with those constraints? So what am I talking about? I'm talking about energy. I'm talking about even all the way down to the copper wiring. We're going to need a lot more energy to power this silicon thinking machine moving forward. So I think power generation and then getting the electricity from where it's generated to where it's going to be used is going to be very, very important. So what I'm thinking about from the AI perspective is trying to take the fun out of it, if you will, and really thinking about where are the bottlenecks where we as providers of capital can help while politely requesting our fair return, which I think is appropriate given the scale of the challenge we've all got, the planet has got, to try to create this new thinking machine and the money, clearly the billions, maybe trillions of dollars of funding. Public sector balance sheets are not big enough to do it. It's going to be the private market which provides most of the capital, and we at BlackRock clearly want to be helpful in that regard, driving societies forward, helping economic progress, while again politely requesting a fair return, because that's our job.
And Ben, this energy transition that we've been talking about, maybe the last 4 to 5 years, does that story at all change given the way the geopolitical environment across the globe is changing and evolving and even fluctuating, if I can call it that?
I think the importance of energy security is only increasing. So, as a general statement, we're moving away from a world where we all feel very globalized and it doesn't matter where you get stuff, you just trust in the supply chain and everything will be fine. That was sort of the view 10 years ago. That now feels a little bit naive. For many things, for chips, obviously for defense, for goods and services which have a political and security resonance. And I think energy is on the list of those critical areas which governments all over the world are extremely focused on needing to have confidence around their supply, even if things get a bit wobbly geopolitically or otherwise. So I think the approach to energy is now one of extreme energy pragmatism, where governments are focused on making sure that they are blending the progress we all want to see continue vis-a-vis a cleaner and better world. That absolutely continues. And blending that progress with the need for security of supply in a world where, sadly, we are all, I think, moving towards a more self-reliance and a little bit less trust in the globalized supply chain. So really thinking about whether it's bringing these kind of production home, or at least having deals with countries and counterparties that we feel very, very confident in. The kind of premium around that, I think, is only going to continue to go up.
So if I were to ask you, Ben, to classify your high conviction tactical calls, which is for, say, the next 6 to 12 months, and of course the long-term bets as well for the next 5 years, what would they be?
Yeah, so on the tactical view, as mentioned, we're still bullish the US for the reasons talked about. We also like Japan. That's a very interesting kind of self-help story. They're driving through some very powerful, I think, corporate governance reforms, treating shareholders better. So, by the way, we as global investors, we really notice when we see these kind of structural improvements in terms of, in general, how shareholders are treated. So Japan has been doing that for some period of time, and we're now seeing the kind of fruits of that flow through in terms of a few more buybacks and, in general, a better treatment of shareholders. So I'll just put that out there. We really, really notice when improvements is made. That's not just a kind of 3-month trade. That's a big structural change, which can really kind of excite investors of the scale of a BlackRock running, 13 or 14 trillion dollars, whatever it is today. From an India perspective, I talked about the kind of market and the need to be selective. As a general statement, India valuation looking much better. Just maybe a different comment. I'm also quite constructive on India's local currency bonds. Clearly, we've got very high rates currently, real rates in India. Inflation, you've got a good problem. Inflation is sort of too low at the moment, which is good news, giving the RBI big room for maneuver. If they want to, they don't have to. Obviously, they're mindful of the FX risk. Maybe they want to see clarity on the US situation, which is completely fine. But it does feel like we've got, as global investors, quite attractive yields in emerging market local currency as a general statement. And I would absolutely think that thought vis-a-vis India, where you are having a very, very benign moment vis-a-vis inflation, making your yields, India's yields, look particularly attractive, is how I would say it. So a few thoughts there around the globe, but in India, we talked about the equity market, selectively constructive moving forward, and I would throw in the bond mix, given the inflation context, looks quite favorable.
Ben, let me push you on that point. So 6% on the India 10-year, you believe that it can come off? And if so, by how much? What's the scope looking like and what are the factors? You spoke about the RBI cut, but the delta against the US 10-year is not particularly large. So I'm trying to get a sense as to why you're bullish there.
I agree with the thrust of your question. So just, by the way, we do worry about US inflation. So we do worry that maybe there are kind of more hope than reality in terms of how much the Fed can cut over the next 6 to 12 months. So as a general statement, I totally take your point that maybe we've got a bit of a wake-up call. It's a bit strange, actually, right? We've just had the US government reopen. I was just watching President Trump sign the bill to reopen the US government. So from the American perspective, we're going to get data, which we've been missing for the last several weeks. And maybe we don't want the data, kind of strangely, because what the data might show is an economy where inflation continues to be too high. And that is obviously something the Fed can then incorporate. They'll have data to look at and think about. And I think that might give them a little bit pause for thought in terms of how much cutting they can do. So in terms of your point vis-a-vis the US, I think that point is well made and well taken. But notwithstanding that, India, as a global investor, what am I looking for? I want attractive yields. I want the potential for cutting, I suppose, to come through. I want a program in terms of the regulatory and other framework. I want a catalyst coming forward. Again, we don't know exactly what the US deal is going to look like, but it looks like it's coming relatively soon. So when I throw all of that in the mix, and I would actually say, the fact that India has had a fairly dull 6 to 12 months in terms of market performance, those are quite a nice set of ingredients on a looking forward basis. And that's why, again, I think India is particularly interesting as we look forward over, let's say, the next 6 to 12 months, both equities and fixed income.
And Ben, how do you look at rate cuts in the US? Give us a sense. There's just so many moving parts. You have, Chair Powell likely term to end in May, of course, as mandated. There'll be a new leader at the Fed. Should that likely accelerate rate cuts, in your opinion? And in the run-up to that, how are you penciling in rate cuts? Give us a sense of that.
We still, I guess, have a simplistic view, which is to look at the Fed's mandate. The mandate means mandatory, means not optional. And their mandate is inflation, something like 2%, and let's try and keep employment ticking along. So some version of both of those. And when we look at inflation, in round numbers, inflation is 3%. Again, to repeat, the target is 2%. So they are, substantially above target in the US. And there is a risk that that inflation number is moving higher, not lower, in the months ahead. So you're exactly right. There are many moving parts, lots of theories, and all of that's super interesting, and some of it's important. But let's stay focused on the mandate, would be my message. And the mandate on the inflation side, unfortunately, looks a bit tricky. They are mandated to bring inflation to 2%. Currently, inflation is, in round numbers, 3% and looking like it's moving higher. When I look at that, it just looks unlikely that the Fed can be cutting, let's say, 150 basis points over the next 12 to 18 months. I want to be appropriately humble. Of course, these things are possible, right? I'm not saying it's impossible. But again, when we look at inflation, we look at the mandates, we think the scale of cutting is currently overpriced. We would be thinking one or two more cuts from here is reasonable and justifiable. Beyond that, starts to look a little bit hard because, again, we're simple people, I guess. Inflation is too high. That's a mandate, and they can't ignore that, whoever is running the Fed.
So, Ben, what's the biggest risk that we run right now for equity markets? Because not just all equity markets, like we said, most of them are at record highs, and all asset classes are also doing so well. What could spoil the party?
Yeah, so I think when we think about equity markets, again, maybe I'm a simple soul. There's price and there's earnings, right? That's all that matters. So we need to think about valuations and whether the earnings momentum moving forward can justify current valuations. So we need to be thoughtful around this. For us, again, we would be selective. So I want to be really clear on this. This is a global environment. I'd apply this thought to India. I'd apply it to everywhere. We're all going to have to do a bit more hard work. Sorry about that, but we're all going to have to really pick our spots and be maximally careful about who and which companies, which sectors are the right side of what we call the mega forces, these big structural drivers, and which securities, which sectors are kind of swimming against the tide, and therefore obviously look to position ourselves with the wind at our back to try to make the most of this. So earnings is the answer, right? What can go wrong? If earnings momentum, for example, comes out of the AI story, then we might start to sing a different tune. So we are relentlessly focused on valuations and fundamentals. Is the earnings outlook still sufficiently positive to continue to drive our bullish views? And for now, to the AI point, we think the answer is yes. But I would also be, using that lens, using that frame, really across the board, every sector within the Indian equity market. Are we the right side of these mega forces or not? Then what does valuation look like? And be careful whether you're investing. But again, it's a moment to be picky. It's a time for active. We just think that is necessary to try to make the most of the volatility rather than get bullied around by it, because it's going to continue, I'm afraid to say.
Okay, Ben, great to have you on the show. Thanks as always, so much insight. And the big takeaway is it's time for active investment. Those passive investing days are clearly gone.